I love the stock we'll analyze today. This company is so simple, so profitable, and has outperformed almost everybody. It's not Nvidia, it's not Amazon, it's a boring business, but it's a business that makes money. So in this video, we'll analyze Texas Pacific Land. It's a simple business model. They have around 900,000 acres of land in the Permian Basin, so in Texas. And it turns out that in this area, in these lands, there is some oil. And you have oil majors. I know in France we have Total, you have also ExxonMobil, Chevron. They go to TPL, Texas Pacific Land, and say, oh, that's a nice oil you have here. Can I drill it? Okay, but TPL takes a royalty, like takes 4% of revenue generated from the oil from the drilling. Okay, very well. And then they want to build an infrastructure to drill more oil. Okay, but TPL gets a royalty. Okay, and then Total comes, they want to build a bridge because of new operations, new factory. Okay, but you are using our lands, pay us a royalty. So the business model is finished. That's it. That's the end of the business model. They do some other stuff relating to water management, but most of the business, the core operations of the business is land management. So they have lands in Texas, and it turns out that there is oil in this land, and they get a royalty. So they don't have a lot of employees, maybe 100. They don't have a lot of costs, almost no costs, and they get royalties coming in, revenue coming in. And as you drill more oil, as the oil price moves up, they make more money. So this is a company related to the oil and gas investment. So you have some correlations with the oil price, but I would say it's a better bet. It's a better investment for the oil industry compared to the oil majors because you have the lack of cost. So in case the oil price goes up, you have the tailwind, and in case the stock price goes down, you don't have the headwind because you don't suffer from the high costs. So this is it. You will see some spectacular margins today. You will see some spectacular growth, and this is an American business, so you can literally trade the stock today if you want. This is unbelievable, the thing that they have done. They have been in business since 1888, so a long time ago, and it was some land management privatized and then public again, and that was a mess, and then it was a trust, and then some government issue. But at the end of the day, they have lands, and people use the land, and TPL gets a royalty, gets revenue from the use of their lands. That's the end of the business model. Okay, I have some slides for you today. This is the stock price of TPL, Texas Pacific Land. You see that right now they have a stock price of approximately $1,000. And over the past 5 years, it has gone up with volatility, but has gone up. And you see a score from Stock Unlock of 4.34 out of 5, which is a very good score. And you will understand, you will understand why. Okay, so this is the description of the company. In case you want to hit pause, but yeah, they do water services, land management. They have about 900,000 acres of land and 100 employees. So this is some crazy situation, and the revenue per employee for this company must be completely high. Okay. This is the outperformance of TPL compared to the SPY, to the S&P 500 over the past 5 years. So strong outperformance over 5 years. And this is max. If you had invested 20 years ago in 2004, you would have a gain of 16,000% for TPL and only a meager 400% gain for the S&P 500. So it has been outperforming the index over the past 5 years, but over the past 10 years, 15 years, 20 years, outperforming the major indices. And that's very hard to do, and this company has beautifully done it. You have a comparison with Amazon. So TPL is in green, Amazon is in blue. So this boring business, land management, is outperforming Amazon. If you had invested 20 years ago in these two businesses, you would have made more money with TPL, with this boring business that has not changed over 20 years. This is completely crazy. Okay, now let's talk about the numbers. The CAGR, the compound annual growth rate for the stock, has been 29% over 20 years. So if you had invested 20 years ago, you would have made 29% per year, like annually, over 20 years. This is some spectacular and exactly what you're looking for as a long-term stock picker. This is the kind of golden opportunity. So, I mean, this is maybe my favorite business in the world right now because it is so strong. This is the revenue. Revenue CAGR is 17% over 20 years, which is very solid. Net income plus 18%, so you have some margin improvement, but earnings have grown 18% annually for 20 years, which is great. And this is the EPS, earnings per share, 20% per year. So you have some buybacks for the company. Okay, now let's talk about the margins. The business model is so simple and so profitable because this is a royalty business that it has some spectacular gross margin. And on average, yeah, it was like 90% gross margins, 95% gross margins. They literally don't have cost of goods sold because they don't sell anything. This is just some land royalties, so the gross margins are insanely high. EBIT margin is on average 80%. It has been decreasing a couple of years ago with their water management services, but we are on a very high level. EBIT margin at 80%, net margin at 60%. We are talking about some software-like margins for a business that could not be less software. So we have some spectacular margins for this business. This is the free cash flow over 20 years, CAGR of 21%, growing 20% per year for 20 years. This is unbelievable. And because this is a asset-light business model, they just have royalties, the CapEx is minimal. So we are talking about a CapEx of, what's the most recent data, 40 million. Okay, 40 million. And compared to a free cash flow of 400 million. So that's some minimal capex, and that's strange for the oil and gas industry. And by the way, I didn't mention it, but the market cap right now is about $20 billion. So this is a mid-sized company. Okay, let's continue. The balance sheet. Absolutely zero debt and a lot of cash, a growing cash pile. You have right now about $1 billion of cash. So 5% of the company. This is the return on equity. On average, 72%. I mean, that can be biased, cooked, but remember that return on equity is very high. Return on investment is very high because they don't have operations. They don't have anything for this ratio. So obviously, you have some good return on investments. This is the diluted shares outstanding. This is some buybacks. So between 2004 and let's say 2016, the number of shares was reduced, so they did some buybacks, and after 2016 they did dividends. They shifted their strategy. There are many reasons for this one, but I won't elaborate on this video because that can be a bit too long. But they just give the money back to shareholders, whether it's with dividends or with buybacks. And right now you have a small dividend yield. The most recent is 0.5 dividend yield. That's not that big of a deal. You want to buy TPL for the stock price growth, not for the dividend. And what's about valuation right now? You have a PE ratio, which is quite expensive right now. The PE ratio is 50 now, but it fluctuates a lot. And I remember I first bought TPL in 2020, in November 2020, when oil prices went down and the stock was here at a PE of 18, 19, and the stock went up a lot with the stock price going up a lot and PE ratio going up to 80. I didn't sell at this point. I just bought more here in 2023 with a PE ratio of 20, 25. So you can have good buying opportunities with this business because sometimes every 2 years, every 3 years, it dips and you have some good, reasonable valuation, like a PE of 20 for this business. Right now, I would say the valuation is a bit expensive, but it's decent. It's great enough to be on your watch list and to monitor this business in case it drops in the future. And because free cash flow is approximately the same as earnings, the price to free cash flow is very similar. This is the net income and free cash flow in two colors, so they follow each other. You don't have a mismatch between earnings and cash flow. So it's a company that has, if they have a 60% net profit margin, they have a 60% free cash flow margin. which is enormous, enormous. And now I'd like to share a DCF if we have some assumptions on what the company will do in the future. If I forecast that free cash flow over the next 5 years will grow 20% per year without any buybacks, without any dividend growth, at a price to free cash flow of 25, this stock is overvalued by 25%. Okay. And if you want to be more conservative, if you think the free cash flow over the next 5 years will grow 15% instead of 20%, with a PE ratio of 25, it is 40% overvalued. So I would not say it's cheap at the moment. I would say it's fairly expensive. And in case it drops in the future year, in the future 2 years, that can be a great opportunity for the future. And fun fact, this is what Warren Buffett thought when he was 13, because TPL is the second stock that Warren Buffett bought in his life. So this is some crazy stat here, and he told us during the shareholders meeting in 2022, sorry. And yeah, so that's very interesting. And you have some other famous investors that have held TPL for 70 years, 75 years. So this business was good in the past, it is good now, and I believe it will be good in the future. So in case you are still here in this video, you can comment Warren Buffett, so I know that you know the anecdote about Warren Buffett buying TPL. And that's it for my stock pitch for today. So look it up, do your own due diligence, continue the research, but that's maybe my favorite business in the public markets right now. This is some phenomenal business model with a huge moat. Their lands, nobody can touch them, and I think it will continue to grow earnings, revenue, free cash flow over the next 5 years, 10 years. That's it. And if you want to do these analysis, to learn how to do these analysis with a great framework, I have a coaching program. This is the first link in the description. You can book a call with me and see if you qualify for the coaching program. So you can learn how to find these golden opportunities and build a great portfolio for your long term. Okay, I wish you a good day. Bye-bye.